So, hello friends. Today I'm going to cover the topic, or I would say the one of the subject of MBA, which is there in MBA in Finance, and the name of the subject is Financial Credit and Risk Analysis. Okay, so let's get started with this, and I'm going to cover the first unit of this lesson. So, what do we have in this? The first part. So, as we all know, this is the whole syllabus. Let me just zoom it for all of you. So, this is the syllabus of our first unit. That first unit is of financial credit risk analytics, that is KMBN FM05. It can change, change according to the year. So when I was studying, so at that time it was the code of that. So the lesson, or I would say the unit, the first unit contains the financial credit, the meaning and objective of financial credit risk, credit analysis, 7 C's, which is most important, and you'll find it surely in your exam paper. Credit analysis process, documentation, loan pricing, profitability analysis, regulations, type of credit facilities, various types of credit facilities, cash credit, overdrafts, demand loan, bill finance. So all these things I'm going to cover it today in our today's class. Let's see if we can do that. Okay, so the first of all, the question arises, what is credit risk? So credit risk is the possibility of a loss. It's a possibility. Like we have probability, we all have heard about it in our maths lesson when we were in class 10. So same here, credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. So credit risk arises. So if I say this in clear or simple words, so we can say it is the possibility of a loss, okay, which results from a borrower's failure, the one who, borrows the money, he fails to repay a loan or meet the contractual obligations. Okay, so if I talk about the traditional one, in traditional, it refers to the risk that a lender may not receive the owed principal and interest, which result in an interruption of a cash flow and increased cost for collections. For example, let's suppose I gave 5,000 rupees to one of my friend. Okay, now I am the lender and another one is the borrower. Okay, so there is a possibility the one who has taken my money of 5,000 rupees will not pay back to me. Okay, that is what credit risk is. Okay, excess cash flow may be written to provide additional cover for credit risk. When a lender faces heightened credit risk, it can be mitigated. Yes, credit risk can be mitigated. We all have heard about hedging. We'll talk about it more. Okay, with the help of hedging, we can mitigate the risk, the credit risk. Okay, okay, let's come ahead. So although it's impossible to know exactly who will default on obligation, because we don't know who will say that I am unable to pay or what will happen in the future, that is, this is something we cannot predict it. So same happens here. Interest payment from the borrowers or issuer of a debt obligations are a lender's or an investor's reward for assuming the credit risk. Okay, fine. So now let's go for this next one. Credit risk is the possibility of losing a lender's stakes on due to the possibility of borrowers not paying back a loan. Same happens here, which I gave you the example earlier. The same. See, all these are the same things. Like they are explaining in the different words, language. Otherwise, they all are same. Okay. The next thing which we have is consumer credit risk, which can be measured by the 7 C's. Okay. What are the 7 C's? Credit history, capacity to repay, capital, loan condition, associated collateral, control, conditions, and common sense. So these are the 7 C's which are very important, I would say. Okay, so consumers posing higher credit risk usually end up paying higher interest rate on loans. So let's suppose if a consumer have taken a lot of risk, okay, definitely there will be a lot of interest rate also. And we all have heard about it that higher the interest, okay, I would say higher the risk, higher the profit. So yes, the same things here. Now let's understand this credit risk more deeply. When lender offer mortgages, credit cards, or other type of loan, okay, there is a risk that borrower may not repay the loan. Okay, there is a risk that borrower, the who has taken the money, will not repay the loan. Similarly, if company offer credit to a customer, there is a risk that customer may not pay the invoices. Okay, so when we purchase goods, sometimes we do purchase on the credit as well. So there is a possibility that in the future we will not have a money also to pay back to that person. So there is a credit risk. Same here. Credit risk also describe the risk that a bond issuer may fail to make the payment. The bond issuers, I hope you all know about bond. I'll discuss about this bond also in deep. Okay, so bond issuers, let's suppose we can take the example of government bonds, which are the most trustable one, right? Like the government also issue the bonds. It's a type of you can say a paper where the government will write that I'm taking this 5,000 rupees from you and I'll give back to you with interest after some period of a time. So same happens here. Like we have government bonds, private bonds. Okay, make payment when requested that an insurance company will unable to pay a claim. It happens with the insurance company also. We take insurance so that insurance company can give us the claim. The same happen here. Let's move on. So these are the 7 C's. Let's discuss it here. Okay. So 7 C's of credit. What are the 7 C's? Like we are learning. I'm just repeating it. 7 C's, 7 C's. But what are the 7 C's? 7 C's is a system used by the lender, one who lend the money, to check the credit worthiness of the potential borrowers. Let's suppose if someone is asking me to pay, some amount of money, or you can say anything. Okay. So let's suppose he's asking that I'm in need of 10 lakh rupees. So what I'll do, I cannot give anybody like this. I will check the worthiness, the credit worthiness of that potential borrower. Okay, that whether he or she will be able to pay back that money or not. So the system weights 5 characteristics of borrowers and the conditions of the loan, attempting to estimate the chance of default. Default means he is unable to pay that, and consequently the risk of financial loss for the lender. If there will be a default, then that would be a loss. I would say the financial loss for the lender who is giving the money. So let's see, these are the 7 C's. Character, capacity, what is the character of that person. Okay, a person's personality, you can say. Okay, the nature, behavior, capacity, like whether he's able to pay back the money which he or she has taken. Capital, you can say the capital means the cash, whether he or she is able to pay back that cash. Collateral, like we all know, like we give some securities. So same there, we give security. So next one, condition. Okay, condition, you can say the loan conditions. What are the conditions which we offer while giving the loan? Control conditions, how, or how much it can be mitigated. Next one, common sense. Common sense, you can say, let's suppose if I can see a man who is to whom I'm going to give some money, some amount of money, 5 lakh or 10 lakh. So there is a kind of a perception, you can say, or intuition or opinion, okay, that comes in our mind, that whether he or she will be able to pay back or not. That is common sense. So these are the 7 C's which are checked by the lender to provide payment to the borrower. Okay, so these are also there, like they are saying what I've explained you. Okay, we'll not discuss here much. Okay, so let's start with this character. We have discussed it already. It is also mentioned here that it's, if you want this PPT, I will provide you. You can just comment here in the comment box. I'll do that. Okay, so it is called character. The first C more specifically refers to the credit history. Okay, character. Why do we check the character? To know the credit history. What are the payments? Okay, or you can say what is the reputation of the borrower, whether he or she has done something wrong in the past, like Vijay Mallya, like if we can take. So everybody knows now, if these type of peoples will ask for a credit or for a loan, nobody wants it to give, just because everybody knows that what they did in the bank. So same happens, we'll check the credit history, what he or she has a record, like for the like when we'll go for the government job, people used to say that they used to check the credit, like history of ours, like whether we have any criminal record or all these type of things. So same happens here, definitely before giving money to someone, we'll check the credit history. Next one, capacity. We will be checking the ability to repay a loan, whether a person is able to repay the money which he or she has taken. You can say the again recurring debts, the debts which arises recurring in nature. Okay, assessing the borrower's debt to income. So how can we judge the capacity to repay? By debt to income. What is the debt, and divided by its income. Okay, so lenders calculate DTI by adding a borrower's totally monthly, you can say total monthly debt payment and dividing by the borrower gross monthly income. So this is one of the formula which we all know, like debt payment divided by its monthly income. The lower of an applicant's, you can say the lower of an applicant's of DTI, debt to income, the better chance of qualifying for a new loan. Okay, if the ratio is less, okay, then there is a good chance that you will get a loan. If it is high, then definitely there is high risk, and if it is high risk, then definitely you have to pay high interest. Sometimes it happens, let's suppose if I know the person may possible, it is possible that he or she will not pay back the money. Okay, so what I'll do is I'll charge the higher interest. Okay, so this is also one of the techniques which is used by banks and other financial institutions, even by the persons, to give loan. Capital, the cash, which I've already mentioned, lender also consider any capital of the borrower put towards a potential investment. Okay, a large contribution by the borrower decreases the chance of default. Okay, borrower who can put down a payment on a home, for example, we can say typically find it easier to receive a mortgage. Simple, in simple word, if I explain you, then I can say that if a borrower has a good contribution, okay, a large contribution, okay, so it means he or she will not do this default in the payment. Okay, so same they are explaining here. Collateral, you can see as a security. Let's suppose if I'm giving or I'm taking, let's suppose I'm giving, okay, 10 lakh rupees. So I want something in security. I'll ask that give me something of, around of 15 lakh, so that I can trust you. It's not like if the loan amount is 10 lakh, you will also give me a 10 lakh amount, any car or any paper of your car or your house. Not like that. I want the amount, the collateral amount should be more than the amount of loan. Next, we have conditions. So the conditions of a loan, such as interest rate, what is the interest rate, the amount of principal, the principal amount which we are giving, okay, influence the lender. Okay, it gives a good impact on the lender to desire to finance the borrower. So condition can refer how a borrower intend to use the money. The loan conditions tells that how he or she will use. Let's suppose if someone is taking, loan for, for wanted to go outside the country, so is it a good thing? Like, there is a chance that he will pay back the money? Definitely not. Okay, if someone is taking for good reason, I can say a valid reason, there is a possibility that yes, we can get back our money. If we are a condition, like you can consider here a borrower who apply for a car loan or a home improvement loan, lender may be more likely to approve those loans, right? Because they are specific, because we know the purpose of the conditions of loan, like why he is taking, what he will do with this. Okay, so that is why we have now control conditions. I think the data is not mentioned here. It's okay. I've already told you what is common sense, the intuition, opinion. Okay, if there is a good opinion, if we are thinking by space, or like we used to judge, right, through the facial expressions, the voice modulation, like how he or she is talking. So with that, like if our opinion says that he or she is good behavior, he or she can give the payment back. Okay, I think this video will go quite long, so let me stop the video here only. We'll start again, okay, with the next topic in our next class with this topic of credit analyst. Okay, thank you. Please do like to my video and do subscribe. If you really like it, please do let me know about it. Thank you.